And if you aren't thinking about how are your products actually being tailored to face into institutional flows of capital, I think you're just going to get left for dead, actually. And if you're still playing these sort of circular DeFi games of just moving the same chips around, you're going to have a pretty hard time in the next few years. So that's really our initiative, to take the core product set that we have and build purpose-built products and infrastructure for those flows of capital to come in chain and interact with our core products. Yeah.
This episode is brought to you by Arkham. Arkham allows crypto traders and investors to look inside the wallets of the best traders, largest funds, and most influential players in the crypto markets today. We'll hear more about Arkham later in today's episode. Quick shout out to Permissionless 4 coming this summer to New York, June 24th through June 26th. We'll have speakers from all across the industry, including Hayden Adams, Kyle Samani, Guy Young, and more. Get your tickets today by following the link in today's show notes, and make sure to use code BELL10 to save 10% on your purchase. See you there. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. Hey everyone, this week's episode is a cross post from 0xResearch. We sat down with Guy Young of Ethena Labs to discuss the growth of USDe, the launches of Converge and Ethereal, new products such as USDtb, and more. Enjoy.
What's up, guys? Welcome back to another episode of 0xResearch. Today I'm joined by Guy, founder of Ethena. Thanks for coming on, Guy.
Yeah, thanks for having me on.
Before we get started, you guys expanded quite a bit, both the USD product, and you've started building out new products. Do you want to give a short introduction on what you guys have done over the past 6 months, and maybe we can go from there?
Yeah, for sure. Ethena came to market around just over a year ago now with our first product, which was USDe. Basic idea behind that came from Arthur Hayes' original blog post called Dust on Crust, and essentially it was tokenizing the basis trade in a format that sort of looks and feels a bit like a digital dollar, but obviously looks quite different to normal stablecoins in terms of the risk profile and construction behind it. Yes, I guess we came out in March of last year. We scaled it to just over $6 billion in the first year since we were live, which was the fastest growing dollar asset that we've seen in the space. And I think the piece that interested users the most in terms of that was just the funding rate that was being captured within the asset itself. So, SUSDe produced roughly 19% annualized in 2024 on multi-billion dollars of capital. And so the interesting thing of that is, what else can you start to build on top of an asset that has like a structurally higher return? And I think we started to see, quite a bit of DeFi innovation that was built upon that, whether it was in applications like Pendle, Aave, Morpho, all these different things. And Ethena, I think, is sort of moving now from an issuer of a single product into something that's trying to be a bit more like a platform where we can start to take that core product and innovate on it further. And so the thought process here from our perspective is that there's really like three $50 billion plus opportunities within crypto. One is creating money, and stablecoins or Bitcoin fall into that category. The other one is an exchange. So I think you can look at Binance and Coinbase and see that quite clearly. And then the third one is chains like Solana or Ethereum that manage to build proper ecosystems on top of them. I think the most interesting thing of Ethena is actually that we sit at a very interesting nexus between those three different opportunities, which is in the construction of building money with USDe. We also control, the perps market by having the largest sort of accounts or balances that sit on centralized exchanges when it comes to the hedging flows that sit behind USDe. So it's a very interesting, like, second order thought to have, which is what happens when you control that much flow within the market, and can you be using that in a productive way to bootstrap other exchanges that are building on your product? And so we have a new exchange called Ethereal that's coming out, or is actually just launched as testing out with a few users just this last week. And the core idea here is, like, can we provide a platform that new teams can come and build on USDe as a product and actually support them with the backing that Ethena has. And then the sort of third piece to the puzzle is Converge, which I'm sure we'll jump into more detail. But the idea here is that we're teaming up with Securitize, who is the tokenization partner or chosen partner for BlackRock. So they sort of brought their build product to market and are the chosen partner that they'll be doing, everything else that BlackRock and their other institutional partners do on chain. And the idea here is we're really trying to force the convergence, pun intended, between DeFi and TradFi in the same place. I think the view that we have is that the inflows of institutional capital into the space is the single most important narrative of this entire cycle and, like, going forward. And if you aren't thinking about how are your products actually being tailored to face into institutional flows of capital, I think you're just going to get left for dead, actually. And if you're still playing these sort of circular DeFi games of just moving the same chips around, you're going to have a pretty hard time in the next few years. So that's really our initiative, to take the core product set that we have and build purpose-built products and infrastructure for those flows of capital to come in chain and interact with our core products. Yeah.
Perfect. That makes a lot of sense. I think maybe let's start with Converge. So clearly very different to other L1s, as in it's built with securitized. I assume you guys are going to have permissioned validator sets, and it's going to be more of a permissioned L1, correct?
Yeah, so we've literally just put out the tech roadmap now as we're jumping the call, so I know you haven't had time to look at it. It was very unfortunate timing. No, the idea here is it's not going to be a fully permissioned validator set like you would see within an L1. The way I'd characterize this is that if you really think about a sequencer for the L2s that are in production right now, in many senses, that is the most permissioned version of an execution environment that you can imagine, right? Which is like, if Coinbase doesn't like your transaction, it's not going through. So I think that that's actually the most extreme version of what permissioning actually looks like. What we have in place is actually, so we're using the Arbitrum stack to start with a few customizations that we're going to be making to really push the performance of the EVM like beyond what they have out of the box. But that's like the base execution stack that we're using. And the idea here is that the validators that will be playing a role within this network is actually more of a safety mechanism for institutional capital, where if shit hits the fan in some way and there's been a hack or something on the chain, they can actually sit at the most sensitive piece of the chain, which is essentially the bridging of capital outside of Converge into other places where it can be swapped for ETH or whatever else and sort of be taken away. And so the role that these validators will play is actually as a safety mechanism on the layer 0 DVN side, where essentially if something goes wrong on the chain and one of these institutional partners has some sort of loss or hack or some sort of issue with North Korea, whatever it is, you have the ability to actually throttle flows in and out of the chain where required through the bridging piece. And so really it's actually just getting them involved from a security perspective more than anything else. Yeah.
That makes sense. I have a question regarding asset issuance, and I was going to work on Converge. I assume that real world assets like TradFi bridging coming over, that's going to be issued on Converge. What
Correct.
happens with USDe, the contracts that are on Ethereum? Is that going to be moving around?
Yeah, so we do plan to actually open up like native minting on Converge as well. But for us, it looks a little bit different, I think, to most applications, because if you're a dollar issuer, you don't actually really care where you're issuing the asset. It's kind of like if there is demand for this asset on Solana, on Ton, or wherever it is, your job is actually just to produce the asset and then deliver it where there is demand. And so sort of the concept of like native minting for us is slightly less important, because really what's happening is like the asset flows that are coming into Ethena are actually just being sent to custodians that are holding these assets, facing centralized exchanges on the other side. So for us, it really doesn't matter too much if like the actual native minting is happening on ETH, Solana, or Converge, or wherever it is. It's really just a gateway that sort of USDC and USDT are flowing into Ethena. But yeah, we do plan to sort of provide that functionality on Converge, just because it's obviously going to be the home base for a lot of what we're doing.
That makes sense. And in terms of non-USDe assets, what are you planning on offering that isn't currently available elsewhere? Is there anything like, are you going to bring in private equity, credit? Is that something in mind?
Yeah, so I think the really interesting piece about this is that Ethena and Securitize sort of come from different pieces of the market, right? You have Ethena with crypto native assets, which we're trying to package up in a format that we can actually export out into TradFi, while Securitize are taking TradFi native assets and packaging them up in a way that we can bring them into crypto and then wrap financial primitives around them that make sense. And so I wrote about this in the blog post that I put out at the beginning of this year, but we have this product called USDe, which is coming to market relatively soon. The basic idea around this is that we're actually taking the core USDe product and then wrapping it up in a compliant format, which has basic permissioning and KYC restrictions around it. The interesting piece about this is that it actually opens up basically any TradFi entity in the world who manages money to basically just say, we're going to set up an investment structure that sits on top of this, and if you want to get exposure to the underlying, you can just send fiat, and that's like all you need to do. So that's really going to be like the core asset that we're delivering to Converge. We believe that like the demand for this type of product in TradFi specifically is not like $5 billion. It's like north of 100 if you can do it properly. Producing mid-teen returns on dollars is really like the killer product that you can actually export out of crypto into TradFi. And taking that asset, putting it on Converge, and then asking ourselves the question of what else can we do with this in the same way that we built all of these DeFi applications and financial infrastructure around the core USDe asset, you can start to actually deliver that for TradFi. So I think the most basic example here is actually think about what we've done with Pendle, right? Which is just turning like the floating rate of interest with USDe into something that's fixed. A fixed rate of 12 to 15% for TradFi. There's just an insane amount of demand for something like that, but you can't actually deliver it to them if you have like non-KYC'd users who are buying like the YTs within the Pendle pools. And so this is a very key piece for us, which is saying, take all of the stuff that we know already works and has product market fit, but deliver it in a format with our assets for TradFi to be able to come in and consume it. And that's kind of the basic thesis of what we're doing now. And then from the securitized side, sorry, just to answer your question directly, yeah, their ambitions obviously extend like far beyond what they've just started with treasuries. I think it's the full spectrum of trying to bring equities on chain. I think you're going to start seeing I know we've already seen that with a few of these perp dexes now who are sort of starting to explore perps and equities. I think that's a super interesting idea. There's going to be something very big that comes out of that. And then different forms of private credit along the spectrum of like T-bills at the most vanilla to everything else. I think there's a very wide spectrum of interesting assets that you can bring on after that, and then start to attach the type of apps that we already have on chain.
Arkham was created to make blockchains human readable and simplify blockchain data so that it is meaningful and useful to the average crypto user. With their new exchange, users can see what the top traders are buying and selling with Arkham Intel, and then trade on that information with Arkham Exchange. To get started, follow the link in the show notes below. Today's episode is brought to you by Ledger, the global leader in digital asset security. Celebrating 10 years of innovation, Ledger is trusted by 7 million users, secures 20% of the world's digital assets, and remains the most secure hardware wallet for your crypto and logins. Follow the link in this episode's show notes to grab your Ledger today.
That makes sense. Something you brought up is that TradFi is going to be very interested in this dollar product that it'll actually not be like a 5 bill thing, but a 500 bill thing. Is there a limit to that it can scale just because of the way Ethena works?
For sure, yeah. So I've always kind of viewed actually the constraints for Ethena have never actually been like a demand side problem. It's always been like a supply side one, which is like how much capacity is there in crypto to sort of fill this at like interesting returns. I think the basic way that we think about this is really like Ethena as a percentage of total open interest within the derivative market within crypto. Back in sort of December, Jan, the open interest within all of crypto, so that includes CeFi plus DeFi, was roughly $110 billion. And we see ourselves as being, the normal constraint that we run into is roughly 25% of that number. So we're sitting there at 5. And if we'd set ourselves up with the right infrastructure to be facing TradFi, have it as like collateral on Binance, all these things that we haven't sort of achieved yet, I think that we should have been like 20 bill of supply back in December, Jan, based on where the market was at. I think the most interesting thing about this market, though, and you've seen it with the emergence of like a Hyperliquid and how well some of these exchanges have grown, is actually that the derivative market tends to grow at a quicker speed than the underlying market caps themselves. So if you just look at BTC in Jan 24, it was around 50K. And when it went from 50K to 100K, the open interest on BTC actually tripled during that same period of time. And so what we actually tend to notice, and the same thing happened last cycle, is actually that derivatives grow at a quicker pace than the underlying market caps. And so it tripled when the price of BTC doubled. And again, I think that's just like another indication to us that, we thought that we could be roughly 20-ish bill in market conditions that were like favorable a few months ago. But if BTC is at like 200K, that number is like well north of that. Yeah.
That makes sense. I have one more question before we get into Ethereal. In terms of staking, so you offer yield from staked ETH as well. Are you considering other assets, or do you think you need some form of stability or like a maturity per asset to be able to do that? Like Solana is, I guess, like the example here.
Yeah, we definitely could. I think Sol's also a little bit more interesting just because the staking yield was quite a bit higher than we saw with Steth. I think this is something that I've actually changed my mind on since we came out with the original product, which was when I first designed Ethena, staking rates on ETH were roughly 5 to 6%, and that kind of drifted below 3 in the period of time that it took us to sort of like build and ship the product. And I don't know what your perspective is on this, and I'm interested in your view, but it has kind of got to a level now where I actually think the return that you're making from staking ETH does not appropriately compensate you for the duration and liquidity risk that you're assuming while you do that. I.e., I just think the number is too small. So actually Ethena, in the beginning we're like 80% backed by like LSTs, and now it's that number's like sub 10%, and it's going like sub 5%. Essentially, it's become like completely insignificant versus what we're doing. And I think what I realized was actually that users don't want something that's like maybe 1% higher in yield, but has like a little bit higher chance of like depeg or some issue going on. They actually rather just have something that's, 99.9% secure most of the time. And they're happy to not be compensated with slightly more yield, which I think is actually the rational choice. And so I think that's actually kind of where we landed with Ethena, which is we're trying to push a little bit less into doing riskier things, which give you a bit more return. And I think a lot of the competitors of Ethena that are coming to market, that's kind of the only angle that they're taking now, which is kind of like we can take more risk than they can. And I think our view is that we're at the size and we've created enough Lindy and trust with people now that our only job is just like don't mess it up rather than sort of push the risk boundary too far.
Yeah, I think that makes sense, especially if your competitors realistically are offering 2-3%, and that's for exchanges. You don't really have to take an extra percent or two risk just because you already have the yield. I have one more question with risk. Is there anything that you didn't account for when you first designed Ethena? In terms, it can be risk, it can be anything, like something that really you've had time now. The product has become Lindy, as you said. Is there anything that came up that you were like, wow, we could have never expected this? Like we should have had a contingency plan for this, or we should have figured this out earlier, or not?
Yeah, I don't know if this is famous last words, but it doesn't feel like there's been anything that's like completely shocked us. I think the moments where people have seen hiccups with Ethena, it's been ideas that have been well telegraphed well ahead. So the stuff that you saw with Bybit a couple of months ago was obviously people's first thought at that moment was something's probably going to go wrong with Ethena, and I think we sort of came out the other side of that with reasonably strong colors. I think the one thing that we did a pretty poor job of explaining, which wasn't that intuitive, was actually when the markets are melting down and you see like these huge liquidation cascades. I think people often used to think like, how is Ethena not having any issues in the background when perhaps are dislocating from spot by like 5% and that kind of stuff. If you remember, we had that like largest liquidation event in history around 2-ish months ago now, when ETH like cascaded down to 2.2K. The really interesting thing about Ethena's design is actually that like during those moments, you're actually positioned on the right side of the market because you're actually short the instrument that's dislocating to the downside, if that makes sense, because everyone's getting liquidated on the perps. So you're short, you thought you're delta neutral, but actually you picked up like 5-7% more unrealized P&L that you didn't think should exist there in the beginning. So I think that's been one thing that's been interesting to play out in real time, which is kind of like when you see these chaotic events, Ethena can just close these pair positions and actually capture like millions of dollars of revenue that we didn't actually expect to have while it was happening. And I think that was just another piece of the design which we should have done a better job of sort of explaining in the beginning, which is like people were freaking out every time the market was crashing while we're actually making more revenue during those periods. So that was one bit we should have improved on. Yeah,
that makes sense. Okay, back to Converge. Can you talk a bit about USDtb and how it sits with USDe? Is that going to become a core product? Is it going to be something else?
Yeah, for sure. I think the view that we had here is that USDe is backed by the pair positions, but then also just normal liquid stablecoins for when either funding is like unattractive and is there to sort of protect from the negative funding environment, or B, just for liquidity. When people want their money back, we're closing the positions and giving them dollars to be able to redeem from Ethena. I think the interesting opportunity that we saw was that we obviously had reasonably good distribution with the centralized exchanges because they're investors in Ethena, but then also benefit from the flows that we bring to their exchanges via the hedging portion of USDe. And so the view that we had was that actually exchanges were the most important distribution partners if you're ever going to grow a dollar within crypto. Like you're dead in the water unless the big exchanges basically want to push your product. And there was nothing precluding us from basically taking that advantage that we had with distribution with them to say, maybe your users don't want USDe, they want something that's actually just a bit more plain vanilla, and we could sort of offer that product very easily. The more interesting piece is that like internally within Ethena, it's an extremely useful product for us to be able to tap into like the borrow demand within DeFi. So you can sort of think about MakerDAO right now, right, is 3 different sources of yield. You've got Maker who's backing themselves with USDe yield. They've got the T-bills, and then they've got like over-collateralized lending within crypto. The interesting thing about what we can do with USDtb when it's in the backing of USDe is we can actually lend that into Aave, for example, and it allows Ethena to actually double dip on the yields because we own and control USDtb. we have the T-bill yield that's coming through to Ethena. But then in addition to that, you're actually getting the lending rates within Aave, which can be like 3, 4, 5, 10% in the right conditions on top of that. And so it's actually a mechanism through which Ethena can actually have quite a bit of backing of USDe, providing leverage into Aave and other places, and then also collecting like the DeFi lending rates on top of T-bill rates as we do that, which allows us to sort of stack it together in the same instrument. So yeah, I think it was just a very neat product that sort of fit within our distribution strategy. It made centralized exchanges happy because we created the product to sort of share most of the economics with the centralized exchanges. It's not like a big profit center for us. And then it was also extremely helpful for us to internally manage like the backing of USDe without leaking that value to Tether or Circle.
Yeah, that makes sense. But it will not become the main product. Like you guys have no plans to compete with Tether and Circle. It will be a sidecar.
Yeah, exactly. I think it's definitely not the core focus outside of USDe. I think I don't want to be too bearish on other people who are coming to market with new stablecoins, but I think it's way too late now to try and compete with Tether and Circle with plain vanilla forms of stablecoins. I think the network effects and moats that have been built up, particularly within centralized exchanges, are pretty much insurmountable now, unless one of them has a major issue with fraud or like all of the exchanges go bankrupt or whatever it is. I don't really see a viable way that new competitors can actually come in. And the real reason for that is actually that the product is so commoditized, right? Where there's only 3 things you can do. You can either be a dollar, and if you're not a dollar, you're bankrupt like the next day. No one's going to use your product. You can be more liquid, and it's very difficult to be more liquid than Tether when it trades hundreds of billions a day and you're a startup. And then the final one is like return. And that was really the insight that Ethena had, which was you cannot compete on those first 2 axes as a startup. But on the third one, you can do something very interesting, which is kind of what the approach that Ethena took. And so I'm actually kind of really bearish on, I know everyone's trying to create their own stablecoin. There's going to be thousands of people who sort of take a swing at it. I'm incredibly bearish on like their ability to actually eat into market share from Tether and Circle. I think there's going to be a barbell outcome in the end, which is either you want the most liquid instrument for payments and trading, which is Tether, or you want a savings piece of technology that produces the highest return, and that's Ethena on the other side. And to me, that's like the vision of how I see the end state for the market evolving going forward. And then there's like a long tail of 1,000 like subscale offerings after that.
Over the years, we have seen a multitude of hacks, rugs, and bundled launches. The number one way that crypto traders can protect themselves and the wider community is through on-chain analysis, knowing who is moving funds and where those funds are going. Paired with their new exchange, users can see what the top traders are buying and selling with Arkham Intel, and then trade on that information with Arkham Exchange. Arkham's exchange provides traders with the tooling and liquidity to take action in crypto markets based upon their on-chain observations, bringing them the world's first exchange powered by crypto intelligence. To get started, follow the link in the show notes below. Ledger is the global leader in digital asset security, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a comprehensive ecosystem of products and services, making digital ownership more secure and accessible for everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, introduced the world's first secure touchscreens, making it easier and safer to manage your assets. Alongside Ledger Stacks and Ledger Flex, they have also launched the Ledger Security Key app, offering a safer alternative to traditional password management. Follow the link in today's show notes to get started with Ledger today.
With Ethereal, maybe before I ask some questions about that, do you want to give a short introduction on what that's going to look like?
Yeah, sure. So I think at the back end of last year, we sort of had this initiative called like Athena's Network, which is just like a bunch of apps that we're trying to develop on top of our core product. I think the origins actually came from a slightly less fortunate part of like crypto history around. I actually think that Terra Luna did a pretty good job of this, and they didn't do many things that were very good, but actually the one thing that they did pretty well was actually get different applications in the ecosystem to come and build around that core product. And they identified these are the applications that actually make sense to grow demand for UST, and we're actually going to be supportive of different teams coming to build and actually like drive that outcome themselves. So yeah, we came out with like a few ideas of different applications that we thought made sense to build on USDe. I think a perpdex is like pretty obvious here, right? It's like when these things do well, they absorb billions of dollars of dollar demand. So I think like, you know, Hyperliquid, I think got to $2.5 billion at the peaks in terms of USDC that was sitting in there. And it becomes a very nice sink for dollars when it's going well. And then the other side is just a very nice match between Ethena creates all this value for centralized exchanges with, you know, billions of dollars of hedging flow that sits there. Our ability to actually take that hedging flow and actually, you know, support an exchange that exists on chain and help bootstrap it from the beginning is a pretty powerful way to actually get it from zero to something. You can kind of think about it as like the balance that sits behind Ethena, it's not quite like an HLP because it isn't like sometimes taking like directional views on the actual underlying market. But I think it's analogous in the way that we can actually provide liquidity into the exchange from the beginning at huge size to be able to sort of, particularly on the majors as well, to help to bootstrap it in the beginning. So it's like a very nice matchup of like, if the exchange does well, USDe grows as a product, and then Ethena can sort of support on the liquidity side. I think the most interesting thing just taking a step back is that it kind of takes the two killer products of crypto and puts it together in the same place, because having USDe as your native token on the exchange means that you're implicitly like generating yield always whenever you have a dollar on the exchange. And so this idea of capital efficiency of like generating 10, 15, 20% on your dollars while you're trading on the exchange, or even just doing nothing and it becomes like your savings account, to me that's like a really killer product, which is kind of taking dollar with a yield plus perps as the two things that have really found PMF into the same sort of product offering. So yeah, I think that's the thesis behind it, and the team that's sort of working this are ex-Synthetics guys who have come to build the product. Yeah.
Very cool. You mentioned something there where Terra did well. I agree with you. I do think that they did well by having a bunch of products built on them. They had one flaw, but apart from that, I thought it was a good system. The way that they had mirror and anchor and everything. Ethereal and perp dexes make sense. On Converge, are you going to have like lending and money markets? I feel like are a clear fit. Is there anything else that you guys are going for?
Yeah, for sure. So we've got, obviously, Aave is bringing their institutional product onto the chain by default. So that's where they're going to be launching it. It's called Horizon. Morpho are doing the same thing, where, opening up for USDe leverage, providing leverage into the exchange, even like providing loans against private credit type of assets. So, borrowing against a 8 to 10% Apollo fund with USDC on the other side. There's a bunch of different things that you can start to do when you bring private credit into those kind of environments. The other interesting one is insurance. So I don't know if you've seen this reinsurance. There's a couple of these projects that have come out in the last week where essentially you're able to collateralize reinsurance policies in the real world, which are paying you 10 to 12%, like roughly over the last couple of years, with SUSD as the collateral. And so what you're doing there is actually stacking together a crypto native uncorrelated source of yield with a real world, scalable, enormous market, and actually putting them together because you're actually collateralizing that policy with SUSD. So if you just put that product together and then tokenize that and think about what can you start to do with that later, it becomes like very interesting in terms of like other things that fall out of that. So that's one thing I'm pretty excited about, which we haven't really seen succeed at all in crypto so far. And I think the two other ones which make the most sense to me, Pendle has obviously got huge product market fit. So like Ethena contributed to like 55% or 60% of the TVL that sat within Pendle, and it's just a very natural product where all interest rate markets in the real world depend on like a dollar with a yield, and then you're sort of just swapping floating to fixed. So it makes very natural sense that like Ethena is sort of the bedrock for the stuff that Pendle builds. But you can actually take that a step further, which is thinking about securitization of the asset. So you can think about Pendle as actually being the most basic form of securitization, where the PT is like the senior piece of debt, and then the YT is like the equity that sits at the bottom of the structure. But you can take USDe and actually slice it up into 3 or 4 or 5 different forms of risk exposure and say, if you want the AAA like version of USDe, which is like over collateralized by all of these things, we'll pay you 6% or whatever for holding that. And you can actually just take USDe and do what everyone has done with mortgages for the last 30 years and slice and dice and be able to sell them into different pockets. And again, I think this is something that will be quite interesting to TradFi for them to sort of pick risk exposures to the asset. And then the final one we've got building is Maple is bringing like an institutional product on there to think about under-collateralized lending with USDe. So one of the reasons that the under-collateralized lending market has not resurfaced since last cycle is that there is a very basic cost of capital difference between where are people willing to borrow dollars and where are retail people willing to lend to someone like Wintermute. So the issue is that Wintermute wants to pay 10 to 12, but the retail lender wants 15 to 25 because they view it as slightly more risky than it was last cycle. And the reason that there's this gap in the middle is that Circle is taking 4% in the middle, and because they're lending the USDC, but Circle's making that 4% strip in the middle. If you replace that entire sort of lending structure that I've just described there with USDe, you can actually take the embedded yield of USDe and say, we'll give you, like Wintermute will pay you 10, and then USDe will pay you 10 on top of that to the retail user. And so now you actually have a way that credit can actually flow into the system because you're reaching like the minimum cost of capital that the lenders would actually have to get this done. So it becomes more interesting, right, when USDe is proliferated better across centralized exchanges, and market makers actually want to take USDe to trade it on CEXs. But then even more so, because Ethereal is obviously going to be denominated in USDe itself, you can actually use this as a conduit to just get a lot of liquidity into market makers' hands to be able to provide liquidity onto Ethereal as well. So I really think this unlock in the under-collateralized lending market, which is really uniquely enabled by USDe's like embedded return, can be a pretty interesting like return in the market for a piece of the market that I think actually is desperately needed versus last cycle.
Yeah, I think that makes sense. One thing I think I have to ask is, on this entire expansion towards under collateralized lending, or like slicing and dicing USDe, I feel like there's two viewpoints that people hold. One is like, we're introducing way too much risk into a system. The other is, we need credit expansion so that crypto can grow. I assume you're on the side of, we need credit expansion, but what do you think about the other side, which says this is just too much risk that we're introducing into a system?
Yeah, I think it's actually pretty fine, so long as you're being honest about what the risks look like. So people leverage themselves up on Aave every single day, and they take like 10, 15, 20x leverage, looping stETH, looping all these things, and like that's kind of the nature of what happens in permissionless financial markets. Like people are going to take it too far sometimes. Our job is actually just to provide and make sure that the underlying asset itself is as safe and secure as possible, which is like, I never cause a depeg or some issue with the underlying USDe. But then I think everyone's adults, and you need to be accepting of the fact that like in permissionless markets, they're going to take things, they're going to get liquidated on an exchange, they're going to do all these things, but that's really like, it's their loss and then someone else's edge to sort of buy in that moment. And it's we don't want to be irresponsible in terms of encouraging things that we think are fundamentally unsustainable. But I don't think it's like fundamentally unsustainable that Wintermute gets a $50 million loan from a platform. Like that's not something that makes me lose sleep at night than having that sort of exposure. And I think it's actually a bit of the issue that we've had within DeFi in the last 3 to 4 years, which is no one is actually really trying to experiment and push the boundaries on anything. Like we've almost been, when Ethena first came out, if you remember, I remember a lot of the sort of like risk analysis firms were like, oh, this is insane. You should never put it on a money market. You can't leverage this up. And it was just a very strange reaction, because it's like, your job as a risk analyst is not to look at something and go, this isn't a T-bill, so we're not interacting with it at all. It's actually your job to look at it and go, yes, the risk profile is different, but you're also getting paid a different amount. What is the appropriate way that we treat this asset? I.e., it's more haircuts, lower loan to value, these type of things. And so that's actually our job. Is like the whole finance is trying to work out, how do we price the risk of a bunch of different things? Our job isn't to say like, you can never do any of this. And so, I think it's sort of held back a little bit of innovation since last cycle, which is we've almost been too scared to try anything in many cases. And we've sort of just stuck to the same primitives and sort of recycled them in the same ways.
Yeah, that makes sense. I think you guys also got a little unlucky, because obviously the Terra situation happened, and then everybody who saw a stablecoin with above 10% yield said, oh, this is the next Terra, when obviously it's not. It's a completely different product.
Traders, AI enthusiasts, and degens, listen up. The game is changing, and Desk is leading the charge. To celebrate their launch, Desk is running a trading campaign with 3 major highlights. 38% of their token supply will be allocated to airdrops. They're offering the lowest trading fees on Earth, and finally, they will be running a Desk referral program. The more people you invite, the bigger your rewards will be. To get started, click the link in the show notes below and make sure to follow at Trade on Desk. This episode is brought to you by Morpho. Morpho is the first and only DeFi protocol Coinbase has integrated directly into their main app, giving millions of users access to borrow against their Bitcoin on Coinbase. Just as Web 2 companies like Google, Amazon, and Meta were built on internet protocols, the largest financial companies of the future, such as Coinbase, will build on decentralized protocols like Morpho. Whether you're an individual, fund, fintech, or institution, Morpho is for you. Follow the link in today's show notes to try Morpho today.
I guess back to Ethereal, are you worried that it's going to cannibalize some of the relationships you guys have with perps dexes? Or with Sex? I assume with Sexes it'll be fine, but I saw that like you bought a ticker on Hyperliquid, and I assume you're going to be integrated into more dexes going forward. So do you think that's anything?
I think the approach that we've always had is like, we've been I think pretty good at actually staying neutral across the space. Like Ethena would never actually succeed if we're just like a Binance aligned dollar or like a Bybit or whatever it is. I think you actually need to be neutral across the entire space. So we're obviously there to support Ethereal because they're building on our product, and it's great to see that someone wants to build and grow your product. So the fact that basically Hyperliquid has basically just got pure USDC sitting out there through the entire exchange, and it's very difficult to change, just naturally means it's going to be harder for us to get the same outcome there, even though we're obviously pushing to get USD as a ticker on the Hypercore. So yeah, I think the view that we have is that we're pretty neutral across these venues. We want to support them all, and like Ethena actually only works when everyone is sort of comfortable with the fact that we're being integrated broadly. But yeah, I also think the specific way that Hyperliquid's been designed, it's quite difficult for Ethena to use its product in the same way that we have with centralized exchanges. The reason for that is like the most successful use cases on something like portfolio margin on a Bybit, where you can actually put down USDe collateral, collect the yield while you're trading, and then trade anything on the derivative platform like underneath. Right now, like all of the stuff, as you know, on Hyperliquid is USDC margined, and so you can't actually collateralize like an entire portfolio with a different asset and then trade the rest. So it would sit more as like a savings account within the sort of spot side of the exchange, which is kind of the use case that you might have now. But just in terms of the way it's designed right now, it's quite difficult for Ethena to actually be like a really core piece of the exchange, which just naturally means it can never grow that big there, is my view. Yeah.
Yeah, it's a bit unlucky. Hopefully they change that soon and they add extra stablecoin. I have not too many questions left, but this one is something that multiple people wanted me to ask you about, which is a lot of money markets hard code USDe to 1. I know you just answered saying we're all adults here and people need to figure it out themselves. Do you see this becoming an issue ever eventually, or do you think it's up to the protocols and they should deal with it? Like it's not your responsibility.
Yeah, this is definitely a very nuanced topic. I think my view is that actually we should design something that kind of toggles between the two. So the very high level issue here, right, and we can even use Steth as an example here rather than USDe because it kind of applies to all of these like synthetic assets to the underlying. The issue is that you don't want to liquidate people when there's been a temporary dislocation in the price, which you know is incorrect, right? So whatever, you've manipulated an order book that someone's feeding in the Oracle, or there's a flash crash on a curve pool, which you know the underlying is still there and it should trade back to par. So what you really want is actually a time window where it is attached to something which is real, and then we can actually do a human overlay to say either this thing is now insolvent to some degree and you need to like readjust the oracle, or it is fine. So I think the very basic example that we can look at with USDe is it actually makes more sense, I think, to hard code it to 1 as USDT for all periods of time. But then you have some sort of multi-sig step in, which is saying like, if we've hard coded it to 1, but we can see within an hour this wasn't just like a funky liquidation on the exchange, like literally they've lost 10% of the balance that sits behind here, you need a way to step in and then resolve that so the whole thing isn't getting drained on the other side. So I think that there is some balance between these two pieces where you're wanting to solve for, 99% of the time when you're having issues, it's probably going to be that former bucket of like, there is just an oracle issue with something that's been manipulated and there's not like a fundamental insolvency that's in behind the asset. And you should like design for that to be the case for most of the time. And then in those situations where it isn't, I think it's one of those cases where I think actually just humans stepping in to overlay on top of it is actually the most sensible outcome that you can find. Yeah.
That makes sense.
What about you? What's your view on it? Because I know it's very divisive.
I think it's fine to hard code it to 1. That's my like very simple view. I agree with you. It doesn't make a lot of sense because, like you said, there's oracle attacks, there's manipulation. Things just go like this all the time in crypto. It's just the way that like the market's not mature enough to be able to handle everything all the time. I think you just hard code it to 1. Like you said, it makes sense to have somebody look over it. I think people in general just like to look at things. Like you said, this is especially from the risk side, and we have our own risk side. So I'm sure they can speak better on it. But from what I view, sometimes we don't. We want to be more theoretical than practical. And we want to say, oh, this should never be like this. When I don't think it, like markets don't work that way. I don't think you can build on like crypto and be like, oh, we have to do everything the ideal way. Sometimes you have to take some risks to make it work in practice.
Yeah,
that's my view. We saw a few competitors rise up against, I guess, like Ethena competitors. And something that they do is tranching the USDe or like their equivalent of it, the risk. I know you mentioned that Pendle does, like there could be an eventual Pendle product where there's like they're slicing it. Is this something that you guys think you'll ever support on your end, or do you think it's unnecessary?
Yeah, potentially. I don't think it's a bad idea at all, to be honest. I think it just slightly transforms what the products are trying to do. I think one thing that we did find was that actually, when you're trying to take it into places where the real distribution sits, and that's something like a centralized exchange for collateral, Telegram to all of their users and stuff like that, the more financial engineering and complexity that you put into the product, the less easy it is to get into those places, if that makes sense. So like even getting people off of zero when it comes from just like, maybe it's not just T-bills, it's something else that's sitting in the background. That's an enormous lift to actually get people comfortable with what you're doing there. And every time you add on a new layer of like, this is being tranched, or this is like, people just feel like they're being screwed over in some way when you're adding this complexity, and they don't want to actually think about it. So I think the view that we had was that, well, I think it's a perfectly fine idea. I don't have any issue with the way that I think it's resolved that you mentioned that's designed a product like that. And I think it's a worthwhile thing that people should be doing. I think the different view that we had was actually just that simplicity and telling an easier story to distribution partners who could actually help you scale it from 5 to 20. That's kind of the goal that we're after. And whatever marginal benefit that you think that you're sort of gathering within that design, I don't think sort of offsets that distribution advantage that I think you'd find, just keeping it simple.
That makes sense. What do you see as the biggest risk to Ethena over the next year? Is it competing stablecoins, regulation, yield compression? What do you see it?
Yeah, I think it's like probably just general market dynamics, because Athena is obviously pretty reflexive to the cycle in general. Like the growth profile of Athena looks quite odd, where you have these periods of extreme growth where it's adding like 3 or 4 billion in a month, like more than ETFs, and then months of just like flatline and sometimes some bleeding out. So I think for that reason, and it's obviously just like, very much tied to the interest rate cycle and sort of like froth within crypto. I think that would be the more painful thing on our side, which is, you do all this work to integrate and find new platforms and that kind of stuff. But without the market sort of being behind you, it's hard to sort of like keep up with the growth that we had in the same way of last year. So I think that's just more of the things that we sort of think about. But like, unfortunately, it's something that's completely outside of our control, which is just the general, market, strength of the market. So the one thing that we did find as well was that during those lull periods, so we did have this period in 2024 where actually the supply shrunk by like 30% from like 3.6 to $2 and a bit billion during that period. And the thing that we found was actually that in those lull moments, you actually that's the moment you have to lay the groundwork and the infrastructure for us to be able to then come back in the way that we did with sort of doubling the supply in Q4 of last year. And so we've had actually a pretty good period now, it's in the last 2-3 months, where we've been able to sort of lay the groundwork for more exchanges, this USDe institutional product, us launching onto Telegram, which I've written about on the roadmap piece. And so there's a lot of these different avenues now which didn't exist in Q4. And so when the market does come back, I have a pretty high level of confidence that actually we're going to grow a lot quicker than we saw in November and December of last year. And it doesn't really take rates being that high. I think even like 15 to 20, I'd be surprised if USD supply didn't like shoot past 10 bill if the rates are there pretty quickly. Yeah.
Very good. You guys had a fee switch proposal. What metrics are you guys looking at? I don't know if this is something that you can talk about. We can cut it out if you don't want to, but
No, yeah, happy to.
Perfect. What metrics are you guys looking at, and what conditions will you have to see to actually implement it?
Yeah, so I think there is a public piece on our governance forum around like the specific triggers that we're looking at. I think the general view that we have is that actually like Ethena is very early in its life cycle relative to most businesses. It's been around for like a year, and I think sometimes you can actually hurt your product a little bit too much in the beginning, focusing on like distributions back to the token rather than like pushing growth. And I think especially so with a business like Athena's, where it benefits disproportionately from like size and network effects and moats than even something like an exchange. So if you look at something like Tether versus Binance as an example, Tether has like 70 to 75% market share while Binance has 40. And the reason for that is that like when you're the dominant dollar, you just the liquidity benefits and being the largest compounds on itself in such an extreme way that you don't have to really do more than just exist and be the biggest, and you continue being the biggest and compounding that growth. And so for us, like, without sounding cringe, I just do feel that we're so extremely early in like the development for Ethena and where we can go, where I genuinely believe this product is going to be $20 to $50 billion in the next few years. And trying to take too much to capture value back to the token now relative to investing that into putting it on Robinhood, getting into Binance, trying to put it into institutions in the US, backend infrastructure for Telegram, Revolut. Like there's just so many places you haven't brought the product and have grown it that actually I think that money is, in my view, better sort of like spent reinvesting over there. And different businesses have different, like something like a pump fund. It makes total sense that I think you can capture value back to that right now, and there isn't like a ton that you sort of want to grow into making the product bigger and building out that network effect. So yeah, I think it's just slightly different between different businesses, but it's pretty clear, right, that at like even at not large size, it spits off a lot of cash, like 25% interest rates, or even like the averages that we saw in 2024, roughly annualized 18, 19%. Even at like the $5 to $6 billion that we're sitting at now, it's not far off of like $1 billion of gross revenue that's being produced. And so if you believe that like the supply of USDe can actually get to the numbers that I'm describing, it's clear that there is a very clear path to a lot of cash being produced. I think it's just a different viewpoint that I might have, or like longer time horizon in terms of what I'm trying to achieve here, which I think might be slowed down if you're too focused on taking cash out of that product back to the token. So yeah.
For what it's worth, if I'm able to give like a public position, I will say I don't think you guys should do it. Like you said, you guys are. I think in crypto we have a tendency to say, "Oh, I'm a token holder, give me value as quickly as possible." When, like you described, you guys are a startup, early company. You should focus on growing as much as possible, as opposed to distributing.
Yeah, but I think the one thing that people do want to know, and we have done this, is they don't want an equity code to sit on the side and be rugging token holders and actually taking cash to equity. So I think there's actually a sliding scale of what projects need to do. The first thing is you need to confirm to people without any doubt that an equity company is not like trapping cash on the side that is not to the benefit of like the rest of the system. That's something that has been confirmed already with Ethena. We've never taken $1 to equity, and we never will. And then I think after that, it's then a question of like, okay, how much, what is the take rate? How do you think about the distribution, that kind of stuff? But I think at a very basic entry level, if a token has not confirmed that it is not siphoning off the funds to an equity core on the side, in my view, it becomes totally uninvestable, and you shouldn't trust like what's going on in that structure.
Yeah, that makes sense. That's something that definitely needs to change. Just general structure and how it works, and even like token unlock stuff. We don't have any information for a vast majority of projects. So, Guy, I think that's it. That's all I have. Last question is, what do you want? What's your main focus over the next 3 to 6 months? What should people look forward to?
I mean, yeah, there's quite a bit that we ran through on this.
Yeah.
I think the big focus for us is really getting this institutional product out and then shipping Converge, so we can start to interface with those pools of capital. Again, I think the opportunities out there is just so much larger than what we've actually delivered to date, and I think there's not that many projects in the space who have a product that is almost purpose-built and actually tailor-made for those pools of capital. And I think, even sitting in, I know you were at DAS a few weeks ago with the conference that was put on with Blockworks team, and I think, just walking around there, it became very clear to me that actually stablecoins, tokenized assets, are kind of the only two things that TradFi actually care about within the space. That's kind of it. And I think we just feel pretty well positioned with the product set and sort of direction that we're going here to try and capture what's going on with that theme. So yeah, for me, that's the main focus at the moment.
That makes sense. Guy, thank you so much for coming on. This was fantastic.
Cool, man. Appreciate the time. Thank you.